Hello everyone, this is Paul from the APNacademy, and in today's video we're going to be talking about moving averages. Now people will be wondering that what is a price action trader doing with the topic of moving averages. Now in trading, remember, for you to have an edge, you need to have what we call confluences. What do I mean by confluences? By confluences, confluences are factors that come into one place so that your decision making is more firm. What do I mean by that? For example, if I do have a support level or a resistance level aligned in one place, right? And then on top of that, I do have a moving average, and then I have a Fibonacci retracement level in the same place. That level is going to be a very strong level. Let me just illustrate for you here. If I do have a moving average, right? Let's say this is my let's say support area, previous resistance, and price broke above, and this is my moving average. It came and tested here, right? My moving average is here. And then I also have a fib level. I have fib levels here. Let's say the 50% level in this same area here. This area here will become a very strong area for me to start considering making decisions on taking trades from. Why? Because I have a number of factors crossing in the same area. I have my previous level, key area. I have a moving average in this area, and then I have a fib tool level also in the same area. So that's what I mean by confluences. Now, price action traders can also use moving averages in their favor, and it's exactly where we're making this video today. So without wasting time, let's just start straight away. Let's start with what we're going to be covering in this video. The first one is we're going to be talking about what are these moving averages, because most people are using them, but they do not even understand what they are. And then we're going to be looking at their uses. We shall look at their types, and then I am going to recommend for you the moving averages that you should be using and the reason as to why you should be choosing those ones, right? And after that, we're going to be looking at how to set them, because some people are new and they do not know how to set these moving averages. After that, we shall look at how we can trade with these moving averages, and then we shall go to the charts. As usual, if you've been watching our videos, we start with theory before going to the practical bit of it. So I'm going to request you to first pay attention to the theory. We understand everything before we go to the practical bit. We usually do like that so that by the time we go to the charts, everyone is understanding what we're trying to illustrate. Hope we're following, right? So just stick up to the end and you'll see practically everything that we're going to be covering here. Now, let's start immediately with what are the moving averages. Now, most people tend not to understand moving averages. Moving averages are just simply lines, right? Simply lines that are plotted basing on either closure of price, opening of price, or median price. There are very many factors considered just to eliminate the noise that the price is making in the market. Remember, the market is moving with a lot of noise, either up or down, but there's a lot of noise. So moving averages are simply indicators that are plotted basing on either opening of prices, closing of prices, and many other price factors, just to smoothen out the noise that the market is creating or price is creating. Are we together? Are we together, guys? If you're lost somewhere, you can just let me know in the comment section, whatever question you have, and then we shall be able to get back to you. Now, let me just repeat that. Moving averages are indicators that are supposed to be aligning price. Remember, when price is moving, there's a lot of noise. Even if it is printing a high, there's a lot of noise. So, but a moving average is a smooth line that comes in to just align all that noise, right? So all the fluctuations that are happening on the charts caused by the price, the moving average aligns them out, right? So that is how we define moving averages. Hope we are following, right? So let's move on. Now, what are the uses of these moving averages? I'm just going to give you 3 seconds to guess. You've been using them. Some of you have never used them, but having looked at the definition, what do you think are the uses of a moving average? 1, 2, 3. Okay, let's see if you've gotten yourself correct. Now, the first one is it helps us to determine direction. How does it help us determine direction? I'm just going to show you here, no matter the type of moving average that you're using, right? Now, if this is your moving average and price is above it. Price is moving above it. I'm not saying if price crosses it, you should be in an uptrend. No. Listen to what I'm saying carefully. I'm saying if price is moving above it, not just simply crossing, but if it's moving above, if this is the moving average, this one here, right? If the price is moving above this moving average, we're going to be saying that we're in an uptrend. And if price is moving, let's say this is your moving average, this one here, moving average, and price is moving below it, right? We say that we're in a direction of a downtrend. Guys, do not get me wrong. I'm not saying the moment price crosses it. Most of you are trading using that, and it is very wrong. And someone may already be wondering, but why are you only illustrating using one moving average? We only use one moving average on our charts. The moment you bring in two or more, you're not going to be consistent with that moving average. Some of you call them strategies, moving average strategy. You'll never be accurate with that moving average strategy of yours. And we're just going to illustrate that in a few minutes, right? So that's why you see I'm illustrating using only one moving average. It doesn't matter what moving average you're using, whether the simple moving averages, the EMA, the smooth, the linear weighted, you have to have only one moving average on your chart. Because remember, we are combining it with price action. We're not using it just alone. Moving averages are not supposed to be used alone. You're supposed to use it as a confluence, like I mentioned when we started. It's supposed to help you to confluence your area that you've marked, so that you determine which area is actually very strong for me to start looking for my rules I follow to take my trades. Are we together? So this is how it determines direction. When it is moving above it, it's an uptrend. When it's moving below it, it's a downtrend, right? But what about the third type of market movement, which is the ranging market? How does the moving average help us determine? For example, sometimes the market may be moving without making higher highs and lower lows. So you'll realize that the moving average will just be passing through price. The moment price is moving around the moving average, and you plot or you mark your areas of interest using your slabs or rectangles or using your horizontal lines and diagonals, you realize that actually the price is ranging in that particular area. So that's how the moving average helps us to determine the direction of price. Either is it trending upwards, or is it trending downwards, or is it in a ranging direction. So that is one. Then let's go to the second one. Is it acts as support and resistance, or what some people call demand and supply. Let me just show you how it does that. If this is the moving average and price is moving above it, right? This is price moving. This is your MA, moving average. Price is moving above it. Now, remember, we define support as an area. Support is an area below current price where we expect buyers to come into the market. So if price is above this moving average, meaning this moving average is acting as support in this case, right? So when price comes back to this moving average, we shall be looking for things or rules that we look for when we're looking at support. The same rules that you look for or you look out for when price approaches your support level, assuming you don't have a moving average. Those are the same rules you're going to look out for when price is above the moving average and comes back to the moving average, right? When it comes to the moving average, the same rules that you look out for at support are the same rules you're going to be looking out for. For example, you start looking for W's, you start looking for patterns. If it is a falling wedge or channel, you start looking for those patterns that give you buys, right? The same things that you look out for on support are the same things you look out for here. So do not trade it in a way that when it crosses, when price crosses, I'm going to sell. Price can cross and then creates a W just slightly below here, retests it, and then continues up. So do not fall a victim of that. So this is how we use it as a support. Now, what about resistance? How do we use it as a resistance? It's just the other way around. If this is my moving average, sorry, let me just draw it this way around. If this is my moving average and price is moving below it, right? Price is moving below it like this, and it comes back to it. How do we define resistance? Resistance is an area above price, current price, where we expect sellers to come into the market. Now, since this moving average here, let me mark it as MA, since this moving average is above price, we expect it to act as resistance. Just from a definition, we have said resistance is an area above current price, where we expect where we expect we expect sellers to come into the market, right? So if price comes back here, the same rules or the same things or the same aspects we look out for when we're at resistance are the things we're going to be looking at here. For example, you're going to be looking out for your M's, you're going to be looking out for your head and shoulders, you're going to be looking out for all those aspects. A rising wedge, you're going to be looking out for all those aspects that you consider when you're at resistance. That is one. Then two, do not also use it that if price approaches, let me just wrap this, for example, if price approaches, you're in a downtrend, right? Price approaches here and crosses it, then you say that you're now going to buy. We don't use the moving average like that. Hope we are following, guys. We do not use the moving average in that way. We want to see what is happening around it here, and then we look for those things we look out for, or the rules we look out for when we're at resistance, just the opposite as support. Then let's go to the third importance or use of the moving average is it helps to identify or tell a trader if the market is changing trend. How will it help us do that? For example, if this is the moving average and price has been below it, right? Let me just do it like this. Price has been below it, like this. It has been moving below it. And the moving average starts to curve, but price is below it still. Now, the moment price breaks above, right? This is a sign or symbol that there's a possibility this price may not be interested anymore in continuing down. But just this cross is not enough. What shall we want? We shall want the price to come back to the moving average, just the same way you treat breakouts in price action. That's why when we started, I mentioned to you that we don't use the moving average alone. We use it in conjunction with price action. We use it in conjunction with price action. The moment you use it alone, you're going to have false information and you'll always not be consistent. You'll make money for a short period of time and then you lose. That's why you'll hear traders saying, the moving average thing was working out nice for me. I even combined them here and there. But after some time, I kept on losing because you're using them alone. We have to use it in partnership or conjunction with price action, right? So now here this is like a breakout. Now we shall wait for the market to come back and retest and then give us either a pattern or a structure, and then you can take your move, right? That is how it helps us in change of trend. Let's go the other way around. The same way applies to if the market was above this moving average, right? And then let's say it was above the moving average, then it comes and breaks it below, right? We shall wait for the market to come back to the moving average and give us those patterns we look out for to take trades, either rising wedge or an M, any structure around it to signal to us or to indicate to us that we are now going to go down. This is how the moving average helps us in knowing change of trend. And this is very, very important. This is very, very important in the entry timeframes. Remember, we have three categories of timeframes. One, our analysis timeframe. Two, we have our entry timeframe and our refinery timeframes. So we remember change of trend, we look at it or we look out for it in our entry timeframes. So this is going to be very important in your entry timeframes. When it comes to analysis timeframes, we just want to see the position of where the moving average is. And then we go to our entry timeframes to see where is the position of the moving average. Is price above it? And is it aligning with the one in the bigger time frame or analysis time frame? Anyway, we're going to just look at that in a few minutes. So this is how it helps us in knowing change of trend, if the price has changed trend or not yet, right? So let's continue. Let's move on. Let's look at the types of moving averages. We do have very many types of moving averages. The first one is the simple moving average. I'm not going to explain them in detail because we're not interested in knowing what these different types of moving averages are. I'm just going to talk about mostly two that are very common or popular to traders. The first one is simple moving average. The second one is linear weighted moving average. The third one is exponential moving average. The fourth one is smooth moving average. Now, there are very many types of moving averages out there, but these are the common ones used by traders. And even if these are the common ones used by traders, but out of these ones, there are two that stand out. Which are those two? The simple moving average and the exponential moving average. Now, these are the two that most traders use. But even if these are the two that most traders use, most of them don't understand why they're actually using these moving averages. And you may find out that actually, let's say you're a certain type of trader, and you're actually choosing a different type of moving average to use. Now, I'm going to tell you, depending on the type of trader you are and which type of moving average you should choose. Let's start with the simple moving average. Now, simple moving average, this moving average is usually slow in reacting to price. Remember, the moving average is reacting to price, though it is moving in a way that you cannot detect that it's actually moving or changing. You just come back to your chart and realize, hey, it was up, now it's down. So you cannot actually notice that it's moving unless you're very, very keen, right? So the simple moving average is usually very, very slow compared to the other moving averages, right? Now, if it is slow like this, what type of trader is supposed to use this type of moving average? It's supposed to be a trader who is holding trades for a very long period of time, because price is slowly reacting to price. Are we together? Then if you're intraday scalper, which type of moving average is supposed to be using? You're supposed to be using the exponential moving average. Why? Because for it reacts quickly to the price. Are we together? Now, you may find someone who is a long-term trader and is using exponential, which is okay, depending on how the person wants to get maybe into the market earlier and then holds for a longer time. But if you want to if you're a scalper and all that, I don't expect you to be using the simple moving average. Use at least exponential, because exponential is always close to price and reacts quickly to price in case there is a rapid movement or any reaction in the market and all that price is trying to communicate. This type of moving average easily connects to that, right? So these are the types of moving averages that we do have, but mostly these two are the ones that are being used by traders, right? Now, let's move on. Let's look at which moving averages do I recommend to you guys to use. Definitely from what we have spoken about, no matter the type of trader you are, I'm going to recommend you to use the exponential type. And why exponential type? I've already given you the reasons. It reacts quickly to price. Even if you're a long-term trader, I'm going to advise you to use exponential, and I'm going to give you types of moving averages, the periods you're supposed to be setting, even if you've chosen an exponential type. Now, which are those the periods that you're supposed to set even if you've chosen exponential? One of them is the 5 EMA. EMA, by EMA, I'm meaning exponential. EMA stands for exponential moving average. Don't mind my handwriting. So EMA stands for exponential moving average. Now, under EMA, there are very many periods that you can set, right? All lengths of these EMAs, right? There's 5, there's 50, there's 200. This is what I recommend, but you may find people have 8 EMA, people have 20 EMA, people have 21 EMA, and etc, etc. But I do recommend these 3 because out of my experience, the ones that easily react and give us the structures that we do want in the market, right? Now, if you're a scalper, you can plot or you can insert the 5 EMA, and then these other 2 do apply for any type of trader, whether you're a swinger, no matter the type of trader you are, you can apply any of these. Do not apply all of them, guys. Apply only one on your chart, only one moving average, actually one EMA. Do not have 2. I've seen many traders using crossovers, blah, 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 and all that. Those things will not help you, right? Use only one moving average, because at the end of the day, we just want to identify demand and supply areas. We want to be able to make decisions either to buy and sell. Those crossovers, you can bear me witness, they will not work for a long term. They won't work for a short time, and then you start losing. Are we together? Use moving averages in conjunction with price action. What do I mean here? I mean that you have to first do your analysis, then bring in the moving average so that it acts as a confluencing factor, right? So these are the moving averages I do recommend, but I'm only going to stick to these 2 here. But mostly on our examples, I'm going to be using the 200 exponential moving average, because it's the one that I personally use. So you can choose any of them, but personally I use the 200 exponential moving average. If you want, you can use the 50 EMA. If you want, you can use the 200. If you want, you can use the 5, right? So these are the moving averages that I do recommend, and you can also choose any of them because I have used them and I've used them consistently in the way that I'm going to show you. Do not just use them in the ways that I'm discouraging, crossovers and all that. You find someone having 10 moving averages, 5, 4, it will cause confusion. Remember, you just want to have a simple decision to come across your way. Am I buying or am I selling? And how do you do that? By knowing where you are in the market, right? So let's move on. How to set the moving averages in your chart. It doesn't matter if you're using the trading view, if you're using MetaTrader, no matter the type of platform you're using. So you're simply going to go to your indicators, or you're going to go to insert. If you're using MetaTrader, go to insert, then indicators, or if you can easily find the indicators in your navigator, go to indicators, then you're going to select trend, or just simply select moving averages. Some people, when you go to indicators, you're just going to see moving averages there. Select moving averages, and then we're going to set the method as exponential. The method is like the type of moving average. There are very many you're going to see there, but select exponential that I'm recommending to you, right? And then set your length, or what we call period, as the moving average that you've selected. If you've chosen the 5 EMA, you're going to put 5. If you've chosen the 50, you're going to put 50. If you've chosen the 200 EMA, you're going to put 200. Then your shift or offset should be 0. Shift is the same as offset, because some platforms call the shift offset. Some call the offset shift. They interchange them, right? So no matter the platform you're using, just set it to 0. Shift stroke offset should be 0. Then your apply to or source. Now, let me explain this apply to. Most traders do not tend to understand what apply to or source is. Apply to, why do we choose close? Because we want it to be applied to the closure of price. At what price has price closed? What price has that candle closed? So the moving average is going to be marking out the prices. It's going to be moving depending on the closure of prices. But you can set it to many. You can set it to the median price. You can set it to the closure price, opening price. Very many other options are there that you can see. But we are going to choose as our source, or we're going to apply our moving average to the closure of prices. Most traders do not know why they're applying it to close. You just cram. Because someone is using close or open, you're just cramming. But you can alternatively decide to use your way. You can decide, say, I'm interested in opening of prices. I'm interested in closure of prices. I'm interested in median of prices. Then you set it the way you're comfortable with. But I do recommend you use closure of price, because we do make decisions after a certain candle has closed, or a day has closed, a week has closed, an hour has closed, H4 has closed, right? We always wait. You normally hear traders saying, let's wait for this candle to close. Let's wait for the M30 to close. Let's wait for H1 to close. Let's wait for H4 to close, or the daily to close. Why? Because the best decisions are made after seeing how did the other day perform, how did the other week perform. Then we can make a decision. Since it closed in this way, there's a possibility it's going to do this. There are higher chances it's going to do this, right? So that's how you set your moving average. Now, let's go to how do we trade with moving averages. Now, I briefly hinted on this. And I said that you have 3 time frames, but we're going to focus so much on 2, the analysis time frame and the entry time frame. This is 1, this is 2. Now, what are we doing here? We're getting our areas of interest, meaning we're getting our area whereby we're going to slope. Once we identify this area, we go now to our entry time frame to identify change of trend. So our area of interest is like identifying which area am I planning to buy from, which area am I planning to sell from. But since when we identify this area, that means that immediately we are going to buy or sell. We have to go down to our entry time frame. Remember, I told you as a trader, you're supposed to have 3 categories of time frames. The first one is where you do your analysis from. The second one is where you take your entry from. The third one is where you refine your entry from. These 2 they work hand in hand, right? So if you don't have this, make sure you identify them today. You need to have a time frame whereby you do your analysis, and it should be constant. It's one of the things that is making traders not consistent. Someone tells you I'm a swinger, but he's changing the time frames you're doing analysis from. Someone tells you I'm an intraday, but you're taking your entry in swingers time frames. You're saying you are a swinger, you're taking your entries in scalping timeframes, which is very wrong, right? So you have to make sure you choose these 3 categories of timeframes. 1, where you do analysis from, then 2, where you take your entry from, then where you refine that entry from to have a better risk to reward ratio. Now, let's say you have identified my area of interest, and then after identifying that area, I'm not going to take the trade immediately. I have to go to an entry time frame and look out for 2 things. 1, which is change of trend, right? Then 2, I have to look for my confirmation. Your confirmation can be, people take confirmation in different ways, candlestick patterns, or just areas of high frequency and all that. So people tend to use confirmations differently, but most traders use candlestick patterns, right? We have a whole video on candlestick patterns and a whole video on time frame. So if you don't get these aspects, I'm just going to attach the videos so that you'll be able to acquaint yourself with that knowledge, right? So I was saying that, let's assume I do my analysis in weekly. You need to have this. Let's assume I do my analysis in weekly. My analysis time frame is weekly, and then my entry time frame is H4, for example. I'm just giving an example. I'm not saying this is what I do. So if, let's say, I have a W, right? And I have identified this as my neckline, and it's my area of interest where I take my trade from, right? So, and the moving average is just below here. Remember, we said if the moving, this is the moving average. We said that if the moving average is below it and we are, the price is moving above it, what are we in? Just 1 second to answer. We're in an uptrend, right? We're in an uptrend direction. So by technical analysis, this is my area of interest. I've marked it in weekly, and I expect price to come here, right? And you can clearly see that this price, when it comes into this area here, it's going to be confluencing with this moving average. So when price approaches this area, I'm not going to take my trade immediately. But the first thing I want to do is to look at this confluence, where the moving average is and where my area of interest is. So if they are confluencing, I will know this is a very strong area. Now, you can also look for another confluencing factor like Fibonacci retracement levels. If you don't know about Fibonacci retracement levels, we are going to have a full video on it so that you understand how to properly use it, right? So you can bring in aspects like Fibonacci retracement tool. So if they're aligning in the same place, then you can say this is a very strong level of area of interest that you can consider, right? So this is how we use the moving average in a bigger time frame. Then after identifying that, we have to go to the entry time frame, which is now H4. Now H4, you realize that the price may be below it if it reaches this area of ours. Remember, we had the W and we were here, and then the moving average was up, was below the price here. Now in H4, you realize that if when we're coming to retest here, the price will go below the H4 the H4 moving average, right? Because it will be coming down to retest here. It will be on a short-term downtrend to come and retest here. Now, if we reach here, we're looking for buys, right? You know the rules of W's and M's. If you don't know the rules of W's and M's, we also have a whole video about W's and M's here. You can just look through our videos and make sure you get that knowledge. So we expect by the rule of W's and M, the market to come and retest here. So by the time it's coming to retest, in H4, this price will be below this moving average. Are we together? If I'm very fast, slow down the video, or you can rewatch it, or you can just watch it over and over until you get it, if I'm fast for you, right? So it will be below the moving average. But if it reaches there, for us to be able to take this trade, we want the moving average to break above. Remember, we said one of the uses of the moving average is to help us with change of trend. And we need this market to stop being below the moving average and to shift above. And then we shall wait for it to give us. Of course, we also expect the market to break this moving average with price action here. And then on the retest is when we are going to be looking for our candlestick patterns to take our trade. And it should be confluencing with this area here. This is how we theoretically use the moving average. And I've organized down the steps for you. So let me just show them to you. The first one is make sure you mark your key areas like I've just showed to you. Then apply your preferred moving average, which in this case should be exponential, like I've advised you to use or I've recommended to you. Then this moving average, you're not going to use it like the way you've been using it before, right? You're supposed to just use it as confluence. Where is it and all that? We have looked at the uses of moving average. And we said how it determines for us the price direction. If the moving average is below price, we know that its general direction is an uptrend. And if the moving average is above price, we know that its general direction is downtrend, right? And we say that if it's cutting through, we know that the price is ranging. So you have to know the direction in which you are before you can know that this confluence is very strong, or I should not be actually engaging in this type of market. So this is the theory. Now it's time for us to take an example, and then we see how practically whatever we have explained here comes into play. Please stick around and we look at these examples together. You're going to see how you've been misfiring and saying that these things do not work. They actually work, but you've been using them independently and they work for short term, then you start losing your money consistently. So let's just go briefly to the charts and then we see how we bring in this aspect. Okay, so here I'm on my chart. Today I'm also using the MetaTrader 5. I'm using the platform of analysis called MetaTrader. But what we're going to do here, you can use it on whatever platform that you are using, right? So let's try to apply our moving average, and we clearly see if it is going to be confluencing with our price the way we have explained. And we're going to see all the uses, the direction, change of trend. We're going to use it in all aspects up to the current price here. Now, we're going to start a bit behind in historical way until the current price. And I'm going to be doing this example on volatility 75. If you do not know what volatility 75 is, it's a synthetic index, and you trade it on only one broker in the whole world. And I'm going to leave the link in the description. If you want to start practicing to see how to trade volatilities and how they move, make sure you get an account. It's only one broker in the whole world that offers the synthetic indices. So let's get into here. So we come to insert. Let's insert our moving average. So I'm going to come to insert moving average. So I'm going to come to parameters. Now the period I want is 200. Remember, I told you guys I use 200 in case I'm using the moving average. The method is going to be exponential. The other types are here that we mentioned. Then we're going to apply to close. There are many types you can apply to: high, low, median, typical price, weighted close, etc. But we're interested in the closure of price. Then the color is yours. You can choose any color. Some people like pink, some people like black, some people like what, but I like using red and black, right? Red and blue, sorry, and also black sometimes. So I'm going to apply it like that. The thickness, I just don't want it very thick. I want it like that. Then the shift is 0. Then I'll click OK. So you can clearly see, let's first start with what we spoke about, the positioning of the moving average. We say that if the price is above moving average, it's acting as support. So we wait for it to come touch the moving average and create for us price action behavior, not just because it has crossed, now we're supposed to be selling. No, if it is above, we're supposed to be buying. You can clearly see if you had done that here, you'd lose money. Price came, crossed it, you would sell, right? And it bought. It crossed, you would buy, and it did what? It sold. So we don't use the moving average like that. Here it's acting as support and resistance. We clearly know if this is my support. Price can come from up and actually make a false breakout and then break back above, retest, and then continue up. The same thing, since this is acting as your support, it can do the same thing, right? So treat it just the way you treat support and resistance, or what you guys call your demand and supply areas. Do not change that factor, right? So here price was above the moving average, and you can clearly see we said if the moving average is below price, it's in an uptrend. And if it is below it, it's in a downtrend. So we had a short downtrend here, right? So that's the first use that we said. And we said if the moving average is just moving through price, the market is consolidating, sorry. And you can clearly see we had the consolidation aspect here before the market gave us a short price action double bottom before continuing on an uptrend, right? Here price was up, right? And then came back, sorry. Then price came back and then broke this moving average here. So right now we're on a down, where we came down, now we have retested the moving average, and you can clearly see it gave you price action of an M. We have types of an M, and it gave us one of the types of an M, and we came back again to retest it. So when price is below the moving average, it's acting as resistance, right? So in this case here it was acting as support, but here it's acting as resistance. You can clearly see now it's acting as resistance here. We had an M here, the market has come back to retest, and then we expect a push down, right? This is how we use the moving average for direction purposes. Either the market's an uptrend or downtrend. Do not say that when the market crosses it up or down. That's how most of you are using it, and you're losing tons of money. Check here, the market crossed it, you sold it, bought. Came back, crossed down, you sold it, bought, went back up. Okay, the same thing, did the same things here, right? But if you use it in conjunction with the price action, you're always going to be having high probability trades. Of course, it's not a must that you're going to be right all the time, but you're going to be having high probability trades, right? So let's start historically from here. I'm going to start from here, right? Here. So here, let's do analysis using price action. We had an impulsive move, and the market gave us this impulse. And we are interested in the market coming to retest one of the fib levels, either this one or this one or any of them, right? So you mark it there, you do analysis as usual. So I'll delete my, after impulsive move, of course, we have to use a moving average, a Fibonacci retracement tool. We have applied our moving average, meaning all these blue lines you're seeing here are support, are areas of support, this area here, right? So you can clearly see that the moving average is also in that same area. So what happened? The market came, didn't touch one of the moving average properly, but acted as support. It held price, right? But the market came back down and tested this support here. Here we didn't touch. You can clearly zoom, then you can see it. When the price failed to touch, remember, we have to test support. It came back and tested this area here before moving back up. So in this area, in this way here, it's acting clearly as support. Also here it was acting as support, but technically we didn't test this area here, which the market came back to test, right? Let's continue. Price action wise again, let me just delete this just to not confuse us. Price action wise again, what did the market do? It gave us a W and gave us this area here that was supposed to be tested by the market. And what happened? Look at this. The market came back to test it again. Are you seeing? Are you seeing here? Right? The market came back to test this area. That's why I'm emphasizing that do not use the moving average alone. You can set any moving average you want, whether simple or exponential, whether 100, 20, 80, 50, it doesn't matter, but use it in conjunction with your price action. The way you do analysis, you are going to see a very big change in this, right? So here again, it's respecting what we said, right? Now let's move on. Again, the price gave you an area to come and retest. What happened? The market came back and retested. Are you guys seeing this? The market came back and retested. What is it doing? It's confluencing with your moving average, right? Let's move on again. Let's move on. Now, the market gave us an area to test here, but this time around, it was above the price, above the moving average slightly. And what did happen? The market, when it was coming down, it created for us a structure of a continuation downwards. When the market broke it, we retested and then broke the moving average downwards. Now, this here is aligning with the moving average. When we broke the moving average and a structure that is showing us we are continuing down, this is telling you that actually I am changing trend. I'm continuing downwards. And it was clearly given to you by price action here, and breakout and retest properly happened, both of the price action area and of the moving average. You can clearly see this area was tested and also the moving average was tested, right? So here it was giving us a change of trend in a bigger time frame for area of interest. And what happened? Now it's acting as resistance. Remember here it has been acting as support. Now here we're taking it as resistance. Are we together? Now, what happens to resistance? We expect price to come to resistance and gives us those price action parameters we're looking for. What happened here? The market gave us an M. We have three types of an M. We have the double top, the common one, right? Remember when the neckline is not broken, it's not an M. Then we have this second type of M, which the market gave to us here, right? With a lower high, higher high, and then lower high. Then we have the third type with a higher high, but then comes back to break this, right? Now, this is the type of M that was created for us here, where at the resistance and the moving average is giving us that proper confluence. Are you seeing this, guys? It's giving you that proper confluence. I hope we're together. In case I'm very fast for you, just slow down. And if you have questions, just throw them down in the comment section. We shall be able to get back to you, right? Now, let's do, just look at the current price also. Market gave an M, untested level. I think by price action, we do expect this price to come back and test this area here. And what happened? The market came back exactly to test that, and it gave you a rejection here plus an engulfing, and the market is pushing down. Hope you are following here, guys. This is how we use the moving average. No matter the type of moving average you are using, no matter the type of moving average you are using, this is how you're supposed to use it. And your confluence levels will go high. Your probability trades you'll have very many probability trades in case these aspects or confluences are being met, right? Now, this is for identifying area of interest. Now, I've marked my areas of interest. Let's now go back and let's go now to my entry time frame, and we use them. We're going to start from behind here, from here, all right? Here where the price came and tested, this area here, right? So I'm going to focus here, and then we see how we would have used the moving average for taking our trades, right? So what happened when the price came here? Remember, we wanted the market to come and test this neckline here in a bigger time frame. Remember, I told you when it's coming to test, it will be on a downtrend. I think, and downtrend was below the moving average, meaning this was the resistance. Now, what do we want with it? We want the moving average to break above, and then on the retest is when we are taking our trade. Are you getting it? So exactly the price did that. The market was below it. Here it was acting as resistance. So we don't want to take trades when the moving average is still above. We want to take trades. When you take when it's still above, it means you're going to be buying in a resistance area. What do we want? We want the price to first break it. Then on the retest here or close to it, we look for price actions in your entry time frame, and also you can refine in smaller time frame. When you refine in smaller time frame, you'll actually find there was an entry here, and then you take your trade. Are we following, guys? This is the first one, right? Now let's continue. Let's continue. Here again, the price was supposed to come here and to test this area here. We saw it in a bigger time frame. What happened? The same things keep happening. Price went below the moving average, right? So we don't take trades until we break above, because it is acting as a resistance here. So when we break above, you clearly see there's price action here if you refine your entry, and then the market pushed up, right? Let's look at also this aspect. We expect the market to come and retest this area here, which it did, but price actually later broke down. And the moving average is telling you that in this area here, price failed to break above and show you a continuation. When we tested here, price failed to give you a continuation up. Rather, it was giving us lower highs. This was all communication that I am going to continue down. And indeed, price just broke this level, tested it, and continued down. It kept being below the moving average. Now, for those who trade that price has broken, is now above, I'm supposed to buy, you can clearly see what happened, kept happening. You kept losing money here, right? So you're supposed to look out for price action around the moving average, right? Now, let's continue here. Again here, the same thing. What happened? Price was below, so we expected price to come and retest this area here. What happened? We don't take trades when it is still below here. We take trades when it is above, right? With proper price action. Of course, we had a false breakout here, but with price action, you would actually notice this. That's why I'm saying you're supposed to use it as a confluence. Retested it and then pushed up. Again, when it gave us a structure here, when are we supposed to sell? We're supposed to sell when it breaks this support here, because this point is acting as support, the moving average here. So we want it to be broken. Then on the retest is when we take our trade down. The same things keep repeating themselves, guys, and they keep repeating themselves. And actually, even for those who are trading volatility 75, this, you can just try it out with this example. We do have in a bigger time frame. Let's come to our bigger time frame. Let's say daily. We have tested this area, right? Proper confluencing with, we are properly confluencing with this resistance area where the moving average is. I think. So if I'm to take my entry, I would like to take my entry when I am, let's go to H1. I would like to take my entry when I am below this moving average. Are we together? And maybe you can target you can do your price action and you can target this area here, right? But you would like to take your trade when you're below this moving average here. You don't want to take your trade when you're at support, because in this case, it is acting as support, right? Remember, in a big time frame, it is up, but now here, the moving average is below, just like we have been seeing. So we want this support first taken out so that we do not sell at support. This is acting as your support. So we want it to be taken out. By taken out, I mean broken, then retested. When it is retested, it becomes my resistance. So I'll be selling at resistance. It gives me a high probability trade, and then I can take my trade up to down here, right? Someone may be saying it's not a sniper entry and all that. It's because of sniper entries that most of the traders are losing money. It's because of the sniper entries that most of you are in the 99% who are losing money, or 95%, right? So if you found value in this video with whatever I've put together, or whatever our team has come up and put up together, do not forget to smash that thumbs up button. And if you'd like to continue getting videos of this type or this caliber, make sure you subscribe to the channel. We have a lot in store for you, right? So do not forget to subscribe, and I wish you guys a great day.